Shaun Haney here with RealAgriculture.com and RealAg Radio. You can hear every weekday on Rural Radio 147 Sirius XM at 4:30 Eastern. Let's talk markets here today, and we're joined by Brian Voth of IntelliFarm based out of Manitoba. Brian, how's it going?
I'm good. How are you, Shaun?
I think kind of better than the overall markets. I think. I don't think that's hard. I'm having a pretty good day. I interested in your overall 100,000 foot perspective here, as you look at a number of the different charts. Pretty much a slide, a lot of disruption. Of course, the war in Ukraine is still going on. Of course, we got some terrible situations happening in Israel. That's also a geopolitical issue. But as you look at this overall market here right now, what is your sentiment? What do you see happening next year?
Well, I'm still kind of recovering from this bad news bear nickname you gave me there last time. But
I did. That's right.
Yeah. My sentiment really hasn't changed. And unfortunately, now I'm kind of looking at it from a two-pronged approach, because my background is technical analysis. And so every week I write a report for clients on going through all the different grain charts along with currencies and crude oil, that sort of thing. And it was concerning to me when I wrote the report this last weekend how many negative signals were showing up on these grain charts. And this is after we've already slid for the last, whatever, month, two, something like that, that now we're getting more and more sell signals showing up on these charts. And it kind of just reinforces, I know we've talked about this a lot over the last, 12 to 18 months. And, it's been weird for me to wrap my head around being as bearish as I have been, because I am normally the generally optimistic, positive one. And for the last 12 to 18 months, that has not been the case. And I say it unfortunately because there is still a lot of room underneath us on these charts too. As much as a lot of people get caught up in, oh, well, we've already dropped $1, $2 a bushel or whatever since the summer highs, let's say. It's like, yeah, but look at where we are relative to 10 years ago or the last 5 years, excluding the last 2 years or 3 years, let's say, like post or since COVID. We are still at abnormally high values on commodities, period.
Now, my understanding is funds are net short across the board now.
They have established a short position on, I think, pretty much everything as of last week.
That's what I don't like. That's because we know we love those funds when they go net long and they push the market beyond some of the fundamental prices, which you could argue is what happened on the upside. It also happens on the downside. And so now we start to look not only the net short, but how aggressive do those short positions become? That to me is a little bit of concerning signal here in the short term.
It is. And although I can take a contrarian view on that one as well, because of the fact that they are now short, should something else happen, another war or whatever it is,
we short squeeze them.
They are going to have to cover off these short positions. So there is the contrarian view on that particular note, that something could happen that leads to a short covering rally because they get spooked and they want to get out of their short positions, which means they have to buy them all back now. Now, if something like that happens, likely it would be a short-term technical-driven blip, not the start of a new uptrend again. And I think that's an important thing for farms to realize, is that we are in an overall downtrending market, and moves back to the upside now are selling opportunities. They're not the start of a new bull market again.
It hasn't been exactly a sharp decline though. Because as I look at the chart, if we're like in a sleepy sort of like lull, like sideways, sort of slipping and slipping. That I don't know. When I look at the November canola as an example, that's what I sort of see. Is that fair or not?
It is. When we peaked out back in July, let's say, November canola was $8.50, and today we're at $7.04.
Yeah.
And yet, And then the really unfortunate time about when markets started to slip in early to mid July is at that point nobody was adding grain sales because we were in the midst of a lot of drought. Most clients were actually lowering their budgeted yields from what we had originally worked off of.
Right.
In a lot of cases, it was probably by 20 to 30%, maybe a little more in some of the extreme areas. So nobody was looking to add sales at that point, which is too bad because, at that point you could have sold probably $19 new crop canola. And today we're down at 15, 16, something like that. Maybe 17 out to next spring kind of thing. And then the bigger, to add insult to injury, I guess, to an extent, is that yields have been substantially better than anyone would have expected them to be.
That's been kind of the touchy subject that, it definitely seems to be the pattern, even though expectations were very low in some parts. Because I think you got to phrase that appropriately. We don't have like, oh, hey, like we thought they were going to be below average, and wow, we're shocked they're above average. It's relative to the expectations. And why that's important is those are the expectations that get put in from a supply side into the balance sheet that the market then reacts to when we look at some of the demand that's out there that's been somewhat weak and continues to be so. That's why that relative to expectations is important. Yes, some parts yield still really low, not great.
Yep.
But better than we thought, and that's the hard part.
But it was 20 bushel canola instead of 15.
Yeah. That makes a difference.
It was 33% better than expected.
Yeah, I know when you put it like that, it really does make it.
I know, and that's true. Like there was just some absolutely shitty yields out there. There's no question about it. But even there, like you said, it was better than what a lot of farms had set themselves up to expect.
Okay, so now you're not the first analyst that I've talked to as of late that is definitely more on the negative or the concern side here, where we go from here. That's a common thought. What if, to say, build the contrarian point of view, like when everybody's going that way, I'm going this way. Can you build that case here right now when you look at some of the fundamentals at all?
Like from a fundamental standpoint, I can way easier build a case for the oilseed market.
Okay.
For soybeans and canola, just because of the tightness on those balance sheets relative to the grains anyways. Canola, we're still going to have a tight balance sheet because demand has been good, particularly on the crush side. And we don't have enough canola to do our historical export program along with a full crush program. And by default, most buyers are going to satisfy crush demand because those crush plants can only do one thing, and they will limit their exports accordingly. Along with some of the expansions of these plants are going to be coming online here, starting this winter kind of thing. So there's going to be more and more domestic demand on the canola side, and that will have to come out of the export side. Probably not a huge deal because Canadian canola has just been overpriced since 2021 when we had none or very little.
Right.
So it's not that and I think this is an important thing to remember, is that it's not that we have to have prices go up $200 or $300 a ton to ration demand. The demand already has been rationed and hasn't come back the way we had prior to COVID, or prior to 2021, sorry, I should say. So I can see prices on canola staying, a little bit more optimistic or a little higher just because we are still in a tight balance sheet situation. Soybeans are similar. But there too, U.S. soybeans have just been so overpriced relative to South American that the demand is not so much that it needs to be rationed. The demand is just not showing up like it normally would at this time of year. I did see a note this morning that I think China had looked at buying some soybeans out of the PNW, and it was like 110,000 tons or something like that. So maybe we're starting to actually get to a point now where demand is starting to show back up again. And obviously, what happens in South America this winter with production and whatnot is a huge key part of this too, because if they don't have issues, then it's really hard to build any kind of contrarian view about higher prices on oilseeds.
The other part is, everything always seems to come back to corn, but in order for there to be a broad reversal here, we really need corn to come through and lead us through that. I was once taught that wheat does not lead the market higher. That's like that is a false rally. That is not something to be banking on. As we look at what has happened to corn as of late, it definitely previously in the year bounced around quite significantly in both directions. Now has, committed to this slide kind of lower below $5, especially, if you look at the Dees contract. What do you see for corn from a demand standpoint now that we have a little bit better handle on yield?
I mean, at the risk of alienating every U.S. listener out there, I think it gets worse before it gets better.
Well, you're in that camp.
Do you remember that? Do you remember the number I gave you probably like a couple of times ago when we chatted?
Were you like in the 425 category, or did you have a 3 handle on your?
I was
were
a
you a
380 guy. Yeah,
you were a 380 guy. Yeah. There's a number of people in that range of that 385 to 425 seems to be, if I was to pull out everybody that I talk to on a weekly basis or hear on rural radio or see on RFD TV, like there's a bunch of people in that range, which again, I can stick my head in the ground and say, like, I don't believe it. Or I could look at it and be like, hey, what is everybody seeing here? What do you think everybody is seeing?
And I think, again, yeah, I've been bearish for quite a while. Again, the thing to remember is that through 21 and 22, prices got way overdone to the upside. And that rationed a lot of demand. And this is across all commodities. This is not just what I'm talking about. That rationed a lot of demand. And the thing about it, demand is really easy to lose or to shift elsewhere. It takes a lot more to get it back. And the other thing to keep in mind is, when you were talking $7 and $8 corn, what is that going to do to production? Well, of course, everybody's going to grow corn for $7 or $8 because why wouldn't you? It's basically a license to print money, right? So not only do you lose the demand, you oversupply, and now you've got way too much product around and nobody to buy it. So what has to happen to prices? They have to come back down. And I've literally just explained 60 years of ag prices to you right there. That's why everything is cyclical. We go from too much to not enough, and the demand goes the opposite way, and then you find an equilibrium price. But that's also why after that 2012 drought in the US and the high prices we had, we went into a sideways range on corn for 6 years, right, where the bottom end was kind of in that 330, 340 range, and the top end was 390 to, there was some of the spike highs to 425 kind of thing.
Yep.
Like, we're not back to those. And I do think, those old highs, so somewhere between that 390, 425 level, that becomes the new lows going forward. And you basically go from a range here to, we'll now have a range here. If you look historically, that is often what has happened. But you got to also consider what happens on the input side, because inputs just follow according to grain prices, essentially. So you're going to go back, farms are going to go back to the same margins that we historically have had. We had a phenomenal couple of years, and I hope that farms, banked some of that and didn't just spend it all, because you're probably going to go into a period of some lean years again.
You're right. It just, the question though is how, if that's the reality, need those input prices to follow as quickly as the commodity price on the downwards, and it doesn't always happen right in sync in tandem. But if it's a year of adjustment for those input prices to come down, that's some short-term hurt for sure. Looking on that December corn contract with a 5-year chart, okay, mm-hmm, and just trying to get a sense of where we have been relative to going back pre-pandemic. So, if you look at what is pre-pandemic, kind of January of 2020, we're around that like 380. Now
There you go.
in 2019 in July, we were more like 450. Okay, so that's sort of exactly what you're talking about there. And like when the pandemic first happened, we dropped as low as like 315 or something like that.
Yeah.
Even 303.
302. Yeah, say we held on to the $3 number, but barely.
We never found a two handle. It doesn't look like
No.
according to this chart. So
$3.25. So about as close as you can get.
yeah, well, to go back to like August 10th of 2020 and just go super like buy call options galore.
Yep.
Oh my goodness gracious. It's like Back to the Future when Marty finds that sports betting book. Can you imagine the money you could have made?
I've always said if we could figure out how to market for farms in the way that, USDA or Stats Canada can go back and change numbers for the past 3 years, I would have.
Right.
I wouldn't be sitting here talking to you probably, but like, no, I'd still talk to you anyways.
Yeah, well, we would we would for sure. So now, before we wrap up here, demand, that's kind of what you're watching here right now. What is the pace of buying of these commodities? And because that is one of the things, if there is an unexpected amount of demand, that sort of changes some of the equation here.
It does. And the problem is that the demand hasn't been there. That doesn't mean that that's going to be the way, all winter long or anything like that. But so far, demand is lacking. And again, if you go relative to expectations, you look at some of the demand numbers that USDA has penciled into the balance sheets, they are huge increases. And we're nowhere near pace to hit those numbers. And I'm more concerned on the corn side because, you're talking, 2.1, 2.2, whatever billion bushel carryout. Like that's like corn is everywhere to go swimming in kind of thing. And we need that demand to show up. But even if some extra demand shows up, or, even if the yield comes down a bushel or two an acre, it's kind of a drop in the bucket right now. It's not going to materially change that balance sheet right now. Whereas the soybeans are a tighter side to begin with. So demand is a more finicky number there because, a slight increase in demand on the soybean balance sheet has a bigger implication to the bottom line than it does on the corn side.
There's not to look ahead of here to 2024. It could be a lot more attractive plant beans than corn.
It could, but here too, in terms of like you're talking about input prices and everything, we've been doing a lot of budgets with clients for 2024 already, and where prices still are today are still very attractive from a profitability standpoint. But again, I've harped on this for 15 years, and I'm still harping on this, that if you don't do a budget and you don't actually know what your break even is, you also can't tell me that 486 or $5 or $6 corn or whatever is a good or a bad price, because you have no idea. You have no way of referencing it. And if I'm right that there's more downside ahead, probably want to start looking at pricing 2024 crop already.
That cropping budget doesn't need to be like, you don't need to have everything down to the 100th decimal point, but no. Even if it's just broad and looking back at, historical numbers or, adjusting for current environment, like, I've done a bunch of Mind Your Farm business podcasts about budgeting from a financial standpoint, but the crop budget is a part of that. It's a very important component of the crop planning cycle. Why are like, I'm sort of lost as to why everybody, like, why it's not 100% everyone's doing that.
Well, and partially I would say there is, a lot of farms have a lot of old money, and it just was like, I think that at whatever, you can put whatever price you want in there. Yeah, I'm making money because how could I not? They don't actually know that. And it depends a lot on your farm. If you're a highly leveraged farm, then to me, doing budgets and knowing these numbers is way more critical than if you have no debt, because at that point, I could make some general assumptions and tell you kind of where your where profitability is going to be at, and you're going to be so far above that line that it doesn't really matter. But the well-managed farms are definitely knowing these numbers and planning around it because they have to. And you look at, it's always interesting to me because you look at any other business. I mean, I own a business, you own a business. Do you just guess at where your numbers are for your business?
Oh, I try not, because every time there's the first three letters of assume.
Yeah.
It seems to be what always happens when I make those, assumptions.
And I am a numbers person, so I know my own business's numbers, to the decimal point.
Yeah.
But and maybe that's why I'm so passionate about drilling this into clients that no, we need to do these budgets and know where you're at. I've always said, it's so many farms don't like doing budgets, and the bigger problem I have is the ones that just have no interest in doing them, period, and don't care. Because at that point, I don't know who it was, whether it was Danny Kleinfelter or whoever said, the average farm is just a business that goes bankrupt over the span of 40, 50 years.
Know your number.
And yeah, exactly.
Know your numbers. That's
and plan accordingly, because at the end of the day, nobody knows where the highs are going to be. Nobody knows exactly when the market's going to rally or drop. But if you can look at, hey, I can sell soybeans for $14 or $15 or whatever the number is, and I can pencil in, a 10%, 15%, 20% ROI. Yeah, there's some assumptions there on a yield standpoint, obviously. But if you're going off of long-term historical average yields for your farm, then at least you are setting yourself up for success by knowing, okay, I am in a profitable position. At the end of the day, that's what matters.
Yeah. As you're saying that, I'm thinking of you need to look at your financial situation relative to the marketing and your profit margin. You need to eradicate complacency. And when prices are as lofty as they have been, I'm post tense, but like you said, there's still some money to be made in 24 according to where prices are right now. The second that you're complacent in some of this, because hey, on the way up, there was a period there in fall of 2020, as we were talking about here, and parts of 21, where it's pretty easy to be a marketer. The market just keeps going straight. It's like a hockey stick. But now we're in a tougher environment. Margins can be positive. They are tighter though. And so we need to make sure that we push out the complacency. And this is where we really, really kick out some of those bad habits and really grind it out from a financial standpoint of, hey, know your numbers. So I think it's pretty savvy advice, no matter which direction you think the market is headed. We've been talking to Brian Voth of IntelliFarm, based out of Manitoba. Hey, Brian, if somebody wants to get a hold of you and find out about some of the IntelliFarm services, how do they find it?
Best way is go to the website, IntelliFarm.ca, and you'll find all of our information there, contact information. You can shoot us a message there.
Awesome stuff. Hey, thanks a lot, man. I really appreciate it.
Thanks, Shaun.